It is September 23rd. Michael Vaughn with Brian Acker. As we wind down Q3, Brian, let's have a quick performance review of the two main funds.
Absolutely. So our U.S. fund is leading the way. Obviously, we're probably a good 4 percentage points above the S&P 500 total return index. Everything U.S. all the time. Canada, we're still behind. We're still behind by about the same 4 percentage points against the TSX. The issue there is a lot of the sectors that are really overvalued, like in the last 2 weeks, let's say for instance pipelines. Our work shows that pipeline stocks are so overvalued, but they still go up.
Well,
so
people are chasing the yield.
I agree.
You warned against it.
But that's obviously impacting our performance, certainly in the short term, if you looked over, let's say, year to date. But again, overvalued sectors will correct, and that's where we make up performance, I would say.
Is the commodity super cycle over?
I think we can put up the tombstone on that one.
Thanks to China?
Yeah, China obviously is slowing down a lot. We're seeing it in a lot of areas. Gambling, when you look at the Mirage, when you look at Las Vegas Sands, I mean, we are hearing anyway, the number of tourists going to Macau has severely declined. Scotch sales, Johnny Walker Black, etc., is down double digits this year.
Interesting.
Iron ore on the Singapore exchange, actually, there's a futures on iron ore that hit $80 a ton, which is the lowest it's ever been. So,
but this means tough sledding for Canada.
It does, in one aspect. But keep in mind, the way I look at Canada, it's either, it's our oil out west, or basically it's Toronto, Ontario in terms of manufacturing. So as our dollar comes down, I think manufacturing picks up. Keep in mind, Ontario has been a have-not province now for 5 years. So is it our turn? In other words, the commodity areas of Canada will slowly grind down. I include Saskatchewan. We're already hearing Saskatchewan, Regina house prices are down probably 10-15% from their highs. So
they're not shipping potash to China.
There you go. Well, at least shipments are down.
Yeah.
So again, as one area of Canadian economy is soft or certainly goes lower, and as our dollar certainly goes lower, obviously will benefit Ontario, and certainly you wouldn't know it with all the cranes in the sky, but Toronto and Ontario have been suffering for the last 5 years. So.
Well, let's switch back to the U.S. fund, because you have been beating the drum for U.S. assets and the U.S. greenback for a long time. Mm-hmm. It's playing out well.
So far, very well, but this is a long-term call. So, for the next 5 years, I see the U.S. dollar is regaining certainly the reserve currency of the world. It's been kicked around a lot. People say maybe China is the reserve currency of the world. But I think the U.S. dollar, keep in mind, you really have to feel sorry for the people of the U.S. just in terms of all their balance sheets have taken a hit, their housing, their financial crisis certainly hit that country hard.
Well, they paid the price and did the work.
And what a lot of work they've done. Now the pendulum will swing the other way, and they're going to reap the rewards of certainly a workforce that has been certainly laid off and restructured and re-educated. And they did a lot with their banks, and they still do a lot with their banks today, just in terms of additional regulation to make sure that a financial crisis won't happen again, hopefully for another 50 or so years.
I mean, I know your view of bubbles, but I mean, the Russell index has taken a pounding. I know you don't play there.
again, the Russell stocks are almost like the Canadian stocks, okay? So if you look at the average Canadian stock, other than the pipelines and utilities, I mean, it's lower. When you look at Tech Cominco, certainly material stocks, and they have taken a beating, energy stocks in the last month. So it's almost a stealth bear market in those particular areas. But that's fuel, if you will, for good returns down the road. If we can get those sectors cheap enough, down to a very, very low level, then that's fuel for rates of return down the road. So I'm kind of watching them, and obviously on Facebook, there's always conversations of when do you buy these things. So,
how do you think the year ends?
Actually, I think it ends positively. Keep in mind, we had the best performance in the U.S. dollar, and that's gauged by the U.S. dollar index. The best 17-month period for that currency since 1997. Okay, so what happens? And again, it's rather simplistic, I know, but all over the world, people are looking at their portfolios. They're watching the yen fall. They're watching the euro fall and the economic performance of the euro. So more and more money is allocated to U.S. dollars. Right. So once you allocate to U.S. dollars, what are you going to do with them? You got to buy stuff. You can be government T-bills, which yield you nothing, or you can go in the S&P, which yields you about 2%. 2.2%, which is the same as a 10-year treasury, and you get potential growth. So this is, I think, more and more people will go underweight the U.S. to overweight U.S. And again, it takes a period of years for that to happen. But I think the U.S. currency is leading the way, and U.S. dollar assets, they certainly look good this year. They looked fantastic last year, and I think they'll continue to do so. I just want to say one other thing. When this happened before, in the 90s, it started in 92 and went to 2000, the S&P 500 and the Dow were up anywhere from 15 to 30% a year, just because of the strength of the U.S. dollar, money flowing into those assets, especially large caps. So when you look at certainly our work on large cap value, there's a lot of value there, the Pfizers, the Chevrons, etc. So when that money starts to flow in, and it'll go in the S&P 500, and the largest weights are obviously very undervalued, and I think it sets up for a very, very good period.
It's where I want to be. Brian, thanks for your time. I'll come and see you in October.
Michael, always a pleasure. Thank you.